Right now, as you're watching this, there is a computer system sitting inside HMRC that is looking at 55 billion pieces of information every single year. 55 billion. Your bank transfers, your eBay sales, your crypto wallet, the photo you posted on Instagram last weekend of your new car. And here is the part that should stop you in your tracks. That system is not hunting for the super rich. It is not chasing offshore billionaires hiding money in the Cayman Islands. It is looking for you. The person who sold a few things online, the person who does a bit of freelance work on the side, the person with one rental flat, the person who bakes cakes for the neighbors and made a couple of grand doing it. And in 2026, that machine just got a whole lot more powerful. So in the next few minutes, I'm going to show you exactly what HMRC is doing behind the scenes. Why 2026 is the year everything changes, who is actually getting these letters, and most importantly, how you protect yourself. Because I promise you this, the absolute worst time to learn any of this is when a brown envelope is already sitting on your doormat. So stick with me right to the end, because the part most people get wrong is the very last thing I'm going to tell you. Let's get into it. First question. Why 2026? What makes this year the one that actually matters? Because HMRC has been around forever, so why now? It comes down to two things, and once you understand them, everything else clicks into place. The first thing is simple. It has never, ever been easier for them to find you. And I mean never. For years, decades really. HMRC had a reputation: slow, clunky, under-resourced, losing paperwork. And honestly, a lot of that reputation was earned. Things genuinely did slip through the cracks. But here is what changed. They stopped relying on tired human beings who need coffee breaks and holidays. And they started building machines that don't. At the center of all this is a system called Connect. Now, Connect isn't new. It quietly launched back in 2010. And when it started, it was fairly basic. It just cross-checked your bank interest against your pay records. Boring stuff. But over the last 15 years, it has evolved into something almost unrecognizable. Today, Connect pulls information from more than 30 separate sources. Your banks, the land registry, company's house, credit reference agencies, payment processors like PayPal and Stripe, DVLA records, so they can literally check whether you can afford the car sitting on your driveway. Foreign tax authorities in dozens of countries, online marketplaces, and yes, social media. Let me give you a number that puts this in perspective. In the 2024 to 2025 tax year alone, the leads generated by this one system helped HMRC claw back an extra £4.6 billion. £4.6 billion. From a system that originally cost them somewhere in the region of $45 million to build. That is not a cost anymore. That is one of the best returns on investment the British government has ever made. And you don't switch off a machine that prints money like that, ever. Which brings me neatly to the second reason 2026 matters so much. And I'll just be blunt with you here. The government needs the money. Desperately. There is a gap in this country between the tax that should be collected and the tax that actually gets collected. It's called the tax gap. And in recent years, it has sat somewhere around £46 billion. £46 billion that the Treasury believes it is owed and hasn't got. And the government has openly said it wants to recover billions of that using exactly this kind of advanced data analysis. So think about the maths from their side. Where do you find £46 billion? You don't find it by chasing a handful of billionaires with expensive lawyers who'll tie you up in court for a decade. You find it by going after the largest group of people in the country. Ordinary earners, millions and millions of them, a few hundred quid here, 1,000 there. It adds up. And crucially, most of those people won't fight back. They'll panic and pay. We'll come back to that because it's important. Now here's a detail that a lot of people missed. HMRC has been quietly building up its muscle in the real world too, not just online. Reports have shown that the number of staff trained in covert surveillance roughly doubled recently, jumping from around 170 people to well over 300. They've trained alongside police forces. They've even been signing contracts for phone tracking technology. Now, that heavy end of things is aimed at serious organised crime, not the bloke selling trainers on Vinted. But it tells you everything about the direction of travel. This is an organisation that is arming up, not winding down. So that's the why. Now let's talk about the what. Because you're probably sitting there thinking, okay, but what do these letters actually say? And am I even the kind of person they'd bother with? Let me walk you through who is genuinely in the firing line, because it's a broader net than most people realise. Number one, and this is the big one, side hustle sellers. If you sell on eBay, Vinted, Etsy, Depop, Amazon, any of them, listen very carefully. Since 2024, these platforms have been legally required to hand your sales data straight to HMRC. And from April 2026, that reporting is forcefully enforced under law. It's part of an international set of rules, sometimes called DAC7, and it means the platforms themselves are now doing HMRC's data collection for them automatically. The trigger for a platform to report you is if you make more than 30 sales in a calendar year, or you take more than roughly £1,700. And here's the crucial number to burn into your memory. If your total trading income across all platforms combined goes over £1,000 in a tax year, you are legally required to register for self-assessment. That's £1,000 of income, not profit. Gross. Before any expenses. Now I need to clear up a myth right here, because it causes so much panic. You may have heard about a so-called 30-item rule. There is no 30-item rule in tax law. It does not exist. It's a myth that spread through selling communities. If you're just clearing out your old wardrobe, selling things you originally paid more for, that's almost certainly not trading, and you likely owe nothing. The real question HMRC asks is whether you're buying or making things specifically to sell them at a profit. That's the line. Personal clear out on one side, trading on the other. Number two, landlords. If you've got a rental property, even just one, and there's undeclared rental income, or you've overclaimed on expenses, or the numbers just don't add up cleanly, Connect will spot it. It cross-references the land registry against your tax return. HMRC even ran a specific amnesty for this, called the Let Property campaign, aimed squarely at buy-to-let landlords who hadn't declared their income. Number three, freelancers and the gig economy. Consultants, coaches, tutors, photographers, graphic designers, dog walkers, delivery riders, Uber drivers, content creators, anyone earning outside of a normal payslip. If money is changing hands and it's not being declared, you are more visible in 2026 than you have ever been. Number four, crypto traders. HMRC now receives data directly from the exchanges. If you've made gains trading crypto and you haven't declared them, understand this clearly. They already know. And number five, capital gains. Selling a second property, cashing in shares, that kind of thing. It's all tracked. But here is a really important thing to understand about a lot of these letters. Many of them are phishing letters. They are not proof of anything. HMRC isn't 100% certain you've done something wrong. Their system flagged a discrepancy, and they've sent out a letter that basically says, "We think you might owe us money. Please review your affairs." And that phrasing is deliberate. It's psychological, because they know what most people do when a letter from the taxman lands. They panic. And a panicking person volunteers information. A panicking person hands over more than they need to. That's the whole game. They cast a wide net and they let fear do the rest of the work for them. Now let me show you just how good the surveillance side of this has become, because it genuinely surprises people. In 2025, HMRC openly admitted something for the first time. Its AI system monitors social media, publicly, on the record. Now, they were careful to say that trawling through your private accounts is reserved for serious criminal investigations with legal oversight and human officers always having the final say. That's a fair and important caveat, and I want to be accurate about it. But here's the thing. Publicly available posts? Fair game. So picture this scenario. Your tax return shows a modest profit of £14,000, but your public Instagram is full of a brand new Range Rover, luxury holidays, designer everything. To that algorithm, that's not a lifestyle. That's a discrepancy. And a discrepancy is exactly what it's built to find. In fact, according to one tax reform group, over 90% of those nudge letters in the 2024 to 2025 year were triggered by Connect's analysis. 90%. This is not a human sitting there reading your return anymore. It's a machine building what one report chillingly called a picture of your financial life in high definition. And it doesn't stop at the border. Through something called the Common Reporting Standard, tax authorities all over the world now share information with each other constantly. So if you've got overseas assets, an account abroad, property in another country, don't assume it's out of sight. It isn't. Every country wants to sort out its own books, and they've worked out that the fastest way to do that is to grass each other's residents up. Cooperation, they call it. Okay, deep breath. Because I've thrown a lot of doom at you, and now I want to talk about what you actually do about it. Because there is plenty you can do, and knowledge genuinely is your armor here. But first, let's talk about the single biggest change hitting in April 2026. And this one deserves its own section, because it's going to catch a lot of people out. It's called Making Tax Digital for Income Tax. Here's how it works. In plain English, from the 6th of April 2026, if you're a sole trader or a landlord with gross income over £50,000, the old system is gone. No more one relaxed annual tax return every January. Instead, you'll have to submit updates to HMRC 4 times a year, quarterly, using approved compatible software. You have to keep digital records. And the deadlines are fixed. The 7th of August, the 7th of November, the 7th of February, and the 7th of May. Now, why does this matter so much? 2 words, penalties. There's a new points-based penalty system coming in alongside it. Think of it like points on your driving license. Every time you miss a deadline, you get a point. Rack up 4 points as a quarterly filer, and you get hit with a £200 penalty. And then every single late submission after that is another £200. On top of that, there are separate late payment penalties if you don't actually pay the tax on time. Now, in fairness, and I always want to be straight with you, the government has announced a soft landing for the very first year. No penalty points for late quarterly updates during that first 12 months, to let people find their feet. That's genuinely good news. And if you hear scaremongering, that ignores it. Be skeptical. But, and this is a big but, that grace applies to the first cohort only. It is not expected to extend to people joining later, when the threshold drops to £30,000 in 2027, and then £20,000 in 2028. The net is only tightening. And I want you to understand the deeper game here, because it's clever. Making tax digital creates 2 revenue streams for HMRC at once. Stream 1 is the obvious one. Fines and penalties from people who forget a quarterly deadline, and people will forget because life gets busy. Stream 2 is subtler. By making self-employment this much more of an administrative headache, 4 deadlines a year instead of 1, some people will simply give up. They'll pack it in and go back to a normal pay job where the tax comes straight out of the payslip before they ever see it. And from HMRC's point of view, that's the dream. No chasing, no inquiries, just predictable, automatic money every single month. Fewer people slipping through the net. So if you run any kind of side business, any freelance work, or even a small property portfolio, making tax digital needs to be on your radar today. Not in April. Today. Right. Solutions. Here's how you protect yourself, and there are 3 things that genuinely matter. The first one is boring, but it is everything. Document. Everything. If you do any activity outside of PAYE, and I mean anything, keep records. And look, you don't need fancy software to start. An accountant would love me to tell you that you do, but a well-maintained spreadsheet is 1,000 times better than nothing. Track your income. Track your expenses. Keep the receipts, the invoices, the bank statements. Build a paper trail. Because here's the psychology of it from HMRC's side. If they come knocking and you open the door with a clean, complete file in your hand, they think one thing. This person knows exactly what they're doing. Pursuing them is going to cost us more in time and resources than we'll ever get back. Let's go and find an easier target instead. Documentation makes you a hard target, and hard targets get left alone. The second thing, and this one genuinely puts money back in your pocket, is understanding tax efficiency. Because here's what most people simply don't realize. If you're earning income outside of PAYE, you are running a business. And a business gets to deduct its legitimate expenses. You only ever pay tax on profit, not on revenue. Let me make this real. Say you bake cakes for your community and you turn over £3,000 in a year. HMRC writes to you. You panic. You think, oh no, I owe tax on £3,000. But hold on. You bought flour, eggs, sugar, packaging, boxes. You bought a mixer, baking trays, tins. You use part of your home as a kitchen for the business. You drive to deliver the cakes so there's fuel and mileage. You maybe ran a few pounds of ads on Facebook. Every single one of those is an allowable expense. So that £3,000 of revenue? After legitimate deductions, you might only actually owe tax on £500. Or even less. That is the entire difference between people who understand the rules and people who don't. And here's the uncomfortable truth. HMRC is never ever going to write to you and helpfully point out all the expenses you forgot to claim. It's not in their interest for you to be efficient. If you get it wrong and overpay, that's money in their pocket. So you have to know this stuff yourself, or have someone in your corner who does. Which brings me to the third thing, and I'm not here to hard sell you an accountant. But I do want to reframe what a good one actually is. A bad accountant fills in a form. A good accountant looks at your situation and says, "You're paying too much. Here's how we reduce that, completely legally." They know the reliefs and allowances specific to your industry that you've never even heard of. They monitor the constant changes in legislation so you don't have to. And critically, if HMRC does come after you, they are the person who knows exactly how to respond, what to provide, what to push back on. They're not a cost, they're a shield. And if you're running a real operation, the money a good one saves, you should pay their fee several times over. That's not an expense, that's an investment with a return. Now, one more thing before I let you go, and this is the mindset piece that ties it all together. We live in a country where most working people are on PAYE. Their tax is taken automatically before they even see their wages. They have no control over it. When the government wants more, it just adjusts the thresholds and takes it, and there's nothing anyone can do. But everyone else, the self-employed, the entrepreneurs, the landlords, the side hustlers, you are the group HMRC has to actively chase. And they're chasing harder than ever, because the technology finally lets them. But here's what genuinely bothers me about all of this. The vast majority of people caught in this net are not criminals. They're not tax dodgers. They're ordinary people who made an honest mistake or didn't understand a rule or genuinely didn't think their little side hustle needed declaring. And that is completely reasonable. Not everyone dreams of becoming an expert in tax law. But HMRC knows this. They are counting on it. They know most people will panic and pay whatever they're asked. They know most people won't claim all their allowable expenses. They know most people won't push back or get proper advice. That's what makes an easy target. So don't be one. Look, we all have an absolute obligation to pay our taxes. The country needs funding. Public services need funding. Nobody sensible is arguing against that. But you have zero obligation to pay a single penny, more than you legally owe. Zero. Being tax efficient, keeping proper records, staying compliant, protecting yourself. That isn't dodging anything. It's just refusing to be taken advantage of. And in 2026, with all of this ramping up, that mindset matters more than it ever has. So here's exactly what to do this week. If you earn anything outside of pay, don't wait for a letter. Register for self-assessment if you need to. Learn where the £1,000 trading allowance kicks in. Find out if making tax digital applies to you and whether you've got the software sorted. Start documenting everything today, even if it's just a simple spreadsheet. Get ahead of it so that if a letter ever does arrive, you're responding from a position of total strength instead of pure panic. And if this helped you, or if it made you think of someone, a friend, a family member, who really needs to hear it before April, do them a favour and send it their way. Hit like so more people see it and subscribe, because I break this stuff down every single week. Drop me a comment and tell me your biggest worry going into 2026. I read as many as I possibly can. Stay smart, stay documented, and stay one step ahead of them. I'll see you in the next one.